points on the lesson. Live in the hills, but it still get a spread. Started with a live, but it still reinvest it. Fear how I feel, then you feel it's a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but they sound like progression. Farmer never plans if he waits for perfection. Fingers to the down.
All right, ladies and gentlemen, I hope you're having a wonderful day. Today was a very simple day. The market went down. A lot of the peace talk comments from yesterday, they got walked back, so we came a little bit lower, but a little bit higher than where we were at on Monday. But the thing I want to talk about right now, I got 3 easy ways to beat volatility. And the best part about it, I made a couple of plays today, and we could highlight some wins, we could highlight some losses, but I want to make sure everybody knows this, and I want to keep it simple and straight to the point. So I'm going to cover all of that. We're going to go over the 3 ways. Again, it is very simple, and then I got a little bit of a bond divergence rant for you. It's going to be good. It's going to be good. Yesterday's shirt was appropriate. I was looking for other, like, I don't know. I don't have any other. Everything else is just Colt gear. But my girlfriend got me this. I've never worn it. She asked me to wear it. I was like, why would I wear this? So I was like, okay, I could wear it on a YouTube video. I ain't going to wear this outside. I love my hot girlfriend anyway. So God bless you. Thank you. Make sure you like the video, and we'll see you on stream. YouTube.com/thestockmarket, baby. But here it is. First simple way. Focus on the fundamentals or the event at hand. This is how you are going to beat volatility. So what do I mean by fundamentals? Literally the data. If you see the plays that we've been going after, we've been going after oil. Why? Because there's fundamentals involved. What I'm trying to say is, even though there's stuff going on in the market, what you want to avoid is high correlation. That's what we see during volatility. When things are heavily correlated and you see stocks from different industries all moving exactly the same, that is actually a warning sign. That is not good. So what we're trying to do is identify pieces of information, or if you're looking for a play, try to find something fundamental. So one thing I want to show, this is recent right here. This is a corn, soybean, wheat, all the soybean oil, all of that. But this is a chart because there is data coming out tomorrow. We are going to get a crop report. This is fundamental. This is what I'm trying to say is, regardless, you want to find a play that, regardless of everything going on, will a piece of news or information be able to drive it and let it break its correlation. This is what we are talking about right here. So you may have heard me say spreads and events. I'm saying find an event or find something fundamental about the play. So here today, I went after Goldman Sachs. This was a put I got, and it was related to the Apple news that they're going to be getting away from some of their financial services, or they're going to bring them in-house. And then I also bought it because it is a broader play affected more fundamentally by the bonds. So remember, we bought JP Morgan. We got those Wells Fargo. We were able to flip them out. We got one left. That one went down. But now, if you've noticed, the banks have been going back. That wasn't a voice crack. Anyways, the banks have been going back and forth, and we've been watching it all. And really, you could see how, regardless of what the market is doing, they are more reactive to either events with their shareholders, have to sell if there's something going on with commodities. What else did they do? If they get in trouble with Russia, there's like all these little fundamental things outside of it that can affect them. So this is what I'm trying to say to focus on. These are very good plays. Again, the whole oil situation, commodities, even why we're playing wheat, like I'm saying, with all of it, it doesn't matter what happens with the Fed or other stuff. If certain fundamental news hits, if oil inventories hit, if we get a bad crop report, if there can't be ships or certain things with supplies, those will be the things that will move you or give you a move during volatility. So that's number 1. Number 2, I love this one. Earnings, baby. So this is a strategy we've covered over, and I hope I could give it to you quickly here. What I'm trying to say is, during volatility, and you're going to see this in the next month or two, so I really hope you get this now so you could understand it. Earnings provides an opportunity, because when the earnings are coming up, the stock starts moving a little bit independent, and then after earnings, depending on how they report, the market could go down, the market could go up, but depending on their report, that company will be able to move independently independently. If you haven't noticed the theme, that's the type of information or that's the news or signals we are looking for. But here it is, and this is what we did today. There's the pre-earnings run-up and the post-earnings run-up. So I made a play on Lulu today, and this was post-earnings. So look at what happened. Even if the market went down, even if people were talking about Ukraine, it didn't matter what was going on. Lulu had earnings. They did good. And what we did was we went for the continuation. After the report, the stock went up. It was good. We were hoping that that would continue. So that's where the continuation comes from. But what I do, and this is where you have to be careful, because I did another play today, Walgreens, and that one got clapped. So this was also a pre-earnings run-up. So you can see good and bad about it, but the whole idea here is you wait a couple minutes either after the earnings and you buy the play afterwards, and then you ride out the wave hoping that it does what it's supposed to do, or you go after it on the pre-earnings and you play it before the company even reports. So why this is important is that essentially before earnings, you have a floor. And this is why I like it during volatility, because if the earnings is coming out, usually the stock won't go down too much, or you could expect, not the stock, the option, you will expect that it'll kind of hit a floor. And then usually coming into the final days or minutes before it reports, you'll notice the premiums will go up. So we've done this many times. I did it today on Walgreens. It didn't work, but now Lululemon, we got like 500% on this. But now, I kind of went through it quick there, but what I want you to really focus on is waiting till the premiums come down. What I look for is essentially, can I get the same price for an option as it was the day before earnings after they report? So if it's a similar price or the premium's not too bad, I'm going to go for it. You could see here on this play in the morning, they were trading for 60 cents. Remember, Lulu had a good earnings. They opened up, but then the stock started dropping. So I waited a couple minutes and that 60 cents went down to 20 bucks. We bought it. And then later in the day, as the stock ended up bouncing and continuing the earnings move, what ended up happening? We got to sell out there for just under $1. It even went up to 160. So second thing, look for earnings and understand pre-earnings and post-earnings. And then finally, baby, number 3, keep it small. Position light. So literally, Bank of America was talking about this bear market rally and what they actually told their clients. Again, none of this is a recommendation. I was just trading extremely risky. Okay, you already know it's extremely risky. You can lose most, if not all, of your financial investments. So please consult with a financial advisor. This is for educational purposes only. I thought we slowed it down there. But what they were telling their clients was literally sell far out of the money calls and position light on both the calls and even on the upside. And what they were saying is position light. In this environment where things could change, we're still expecting more stuff from Russia or anything else that could happen, the Fed, the bonds, and all of that. They are saying position light because if there's a grind up, and what they mean by grind up is big shoots up, little bit down, big shoots up, but it grinds up, it kills premium. That's why you want to sell out of the money. And then if you are positioned light on the actual ownership or the option side, then you are able to actually benefit off of it, but then you could still exit quickly, or even if you're late, it is not going to hurt you, and then you can make money from your call sales. So don't get too crazy with selling premium, but the end of the day, you just got to position light. We've been talking about this. The best way you're going to beat volatility, especially if we're getting massive rallies up, huge drops down, you're watching what these options can do. They can move. So the idea is a small amount of money can go a long way, and use that to play throughout time. But if you keep it small, you will be good and you will be able to handle the volatility. Your morale isn't going to get clapped because you're like, oh, I went for this and got clapped. No, it's like you're keeping it small. You can maneuver. Whereas if you just make one big play and you're wrong during the peak volatility, that could clap a lot. So keep that one in mind. But those are the 3 things. I really hope this helps out. Again, for today, I mean, everything got walked back from yesterday. I mean, that shirt was accurate, but it's crazy to see how it's playing out. There is a couple of things we're looking at. I mean, the yield curve, that is what I want to talk about a little bit, but I'm going to really rant here on this I got something good to show you. You're going to like it, but pretty much yield curve, it did not stay inverted today. And we talked about this yesterday and we've been going over it. What I am looking for is the yield curve to stay inverted. And what do I think will do that? It will probably be the next CPI, the next Fed minutes, or the actual Fed meeting. Those would be things that will really start to move things. And once we really get into the 2s and 10s inverted, that is when it really starts the clock and countdown, and boom, it's there. But today, the 2s and 10s, they have uninverted. It's a small gap, but it's not what it was yesterday. Remember, it was very, very brief, but now we need to talk about the bond divergence. This one is very, very simple. You got another thing today. It's saying tech stocks stocks are defying bond warnings in a historic QQQ TLT gap. So they're even comparing it with tech stocks, which is even crazier because we even see it on the S&P 500, but now they're talking about how they've moved in tandem in recent years, and they're saying that it kind of reflects investors using big tech as an inflation hedge. But now, here's a good quote from it. Those are the headlines, but here's Matt Molly, and he's talking about it. He's a strategist at Miller and Talbach, and he's saying he bets QQQ prices calm down, but here's the quote I want. History tells us that when there is a divergence that develops, it is the bond market that usually gets it right and the stock market that doesn't. So we're going to see how this plays out. This is the big thing here with the divergence because, again, this is one of those external things where I'm saying, yeah, Ukraine and Russia could get worse or better, but it's not going to change the yield curve. The problem with the yield curve, it is very elusive with timing, and it could take about 12 months. So that's the real problem that we have here now. And then on top of it, kind of jumping back to the yield curve in general and the inversion, this is where people are starting to freak out now. And this is what you're going to hear a lot of, okay? So listen to this question today. They asked, Saki Sub, she was not in there, but they were asking her about the yield curve. And they were saying, now that it's inverted, what does this mean? But listen to this answer here, okay?
On the economy, the yield curve for the 10-year Treasury note has inverted. Historically, this is viewed as a sign that investors are pessimistic about the long-term view of the economy and they expect a recession is nearing. So can you tell us what the White House believes is the prospects for recession nearing and how concerned you might be about it?
Sure. As Chairman Powell said after the last Fed meeting, all signs are that this is a strong economy and the probability of a recession within the next year is not particularly elevated. Our team looks at a broad range of indicators to understand the health of the economy now and going forward. This is one, but there are many, many others. And the other important indicators to include as we are assessing where the economy stands are things that, frankly, because of the president's economic plan, we're able to confront from a position of strength. So that's, for example, the fastest economic growth in nearly 40 years, a record 7.4 million jobs created, the fastest decrease in unemployment on record to 3.8%, and the first major economy to return to pre-pandemic levels. So while historically this has been one indicator, it is far from the only one, and many of the other fundamentals that we look at to assess where we are economically are incredibly strong and getting stronger.
So literally, we're going to come back to this video in a couple of years. They asked her the question about the yield curve. What did she say? She said, listen what Jerome Powell said, and Jerome Powell is talking about the 3-month yield curve and the 10-year. So like we talked about yesterday and even a couple weeks ago, the real thing that matters is the 2-year and the 10-year. She's referring to what Powell said a couple weeks ago, that they are looking at the 3-month and 10-year. So why is this important? Boom, baby. 2019. So go look at 2019. You can see the first chart here. The yield curve looks inverted, but if you actually look at right down there, it still says normal because the whole curve was normal except for the 3-month, but we did have inversion. Now, what happened a couple months later? You could see that they started cutting rates. Again, we had that first TLT around there, but then you see the stock market went up, and then eventually we ran into COVID not shortly after. So you did watch them cut rates, and then they did an emergency cut during COVID, but rate cutting kind of preceded stuff, but then you had a weird external event, more or less, right? But what I'm trying to show you is that you did have the 3s and the 10s inverted at one point, but it did play out a little differently, and you did watch the market rip up before then, but the point is, the 2s and 10s were never inverted then. So Powell is mentioning the 3s and 10s. You're going to hear that as the narrative, and then they go on. And like I'm saying, you're going to hear this back. We'll probably look back at this in a couple years because they're saying, well, if anything, things are getting better, and it's going to be interesting how this one plays out. But just that's the main point I want to highlight here, because this is what I'm trying to tell you. Over the next 12 months, you are going to hear this. You're going to hear people saying this. You're going to hear people go back and forth arguing about the yield curve. Again, I'm just telling you, keep the time frame. What my signal is when the curve goes from inverted to normalized and the Fed starts cutting again. Right now, we're talking about raising, and we're not even done raising. So think about how long that's going to take. Again, 12 months ago, ago, people were freaking out about GameStop, lumber going up, CPI wasn't this high. A lot could happen in 12 months is what I'm trying to say, but that is the signal that I'm looking for. But the point is, in the meantime, you're going to hear people talk about this. They're going to mention different parts of the curve. People are going to hang on to Powell's statement about the 3 months in the 10-year, which is very interesting. And then people are going to talk about everything else, and they're going to say, well, even though that's one indicator, there is a lot of other indicators, hibbity hobbity boo. So there's that. I hope you enjoyed the rant, but I really hope you learn from this and really take this home and just prepare yourself over the next few months, because be prepared. The market could go up. And like I'm saying, in this environment where you have historical bond divergence, yield curve, but you see the market has been able to go up, this is what creates that flash crash scenario. So just keep watching out for it, but I really hope you're learning. I hope you're patient. I hope you can take all the strategies that we discussed at the beginning of this so that you can be prepared, have money for the next move, and let's go, baby. But yeah, that's it. Again, my plays, again, Goldman Sachs today. And then what's the other one that we made? Oh yeah, earnings. We're going to see the Walgreens, that before and after tomorrow will be one. And then EXC, I still really like it. I sold out of PSX today. That one got us like 100 and something %. A very, very good play. And I think that's pretty much it. So we'll see tomorrow. Again, the same plays are all in motion. I would keep your eyes still on the EWGs and VGKs. If anything comes up here too, we'll watch out for it. But I will start looking for earnings, but we got to be careful like last time, all right? So watch yourself. But Chad, I love you. Have a wonderful evening. I still don't know how to end the videos like this, but just I'll tell you, control what you can control, baby. It gets me hyped, baby, and I love you and really appreciate all of you, especially if you made it this far. I know you guys make it this far in the streams and all of that, but I really love you guys, and I thank you for being here, and I hope you know I'm right here with you, baby, so let's go every day. Who's with me? Oh, God, is that better? I don't, okay.